All right, joining us now for more on the market's close is Jeff Small, president of Arbor Financial. Jeff, great to see you here today. Let's just talk about the month of August. Like we said, a ton of volatility here. What would you say is the biggest takeaway now that we're on the last trading day, have closed out the last trading day of the month? What's the biggest takeaway in the markets for August for you?
I think the biggest takeaway was the 50 basis point drop in U.S. Treasuries. I don't think we've ever seen anything like that before, and it's an ominous sign that the China trade war is starting to just not affect the stock market and global trade, but it's also starting to affect the bond market.
Okay, well, the bond market, as we know, we've been watching that based on the yield curve, at least as one sign of how the bond markets are doing. And this week, I believe it was twice that the 2 and the 10-year reverted again in terms of the yields. A lot more people pouring money, it looks like, into longer-term fixed income assets. Another sign potentially of a flight to safety. Jeff, is that how you read things?
You know, it really is. I mean, if there was any upside here, it's funny to hear all the pundits talk about looking for bond proxies and equities, because when equities are volatile, it doesn't really matter what kind of yield you're getting. It can disappear in a day's trading. But what did rally this past month were corporate. Corporate bonds went up in value, of course, because long-term rates declined. And so if there's a bright silver lining in the bond market, it is in corporates.
So in terms of sectors specifically, what should investors be avoiding at this point, especially in terms of the sectors that are most tethered to global economic slowdowns?
Well, I think energy is the biggest exposure in the event we have a global economic slowdown, and that's really already occurring since all that negative $15 trillion of interest-rated government debt globally has really not done anything for emerging markets or for Europe, so we're not seeing any growth there. The second area I would want to avoid is tech. I think tech has had an incredible run. They've done so well, but they are wide open. If trade gets even uglier and we see the tariffs hit on Sunday and then again more in December, we're going to see tech take another bite.
What about retail? I mean, we know that there are a portion of those retail sort of products that are exempt for this first round in September, but then right after that Black Friday holiday, shopping holiday that is here in the U.S., they're going to maybe kick back in December 15th. Are you staying away from those stocks as well?
You know, there's a few retail stocks that I think are good to own right now. Walmart is one of them. Target is another. Kohl's could be another if you like the dividend play, if you're truly looking for that bond proxy and equities. But as far as other retail sector goes, there aren't too many components that I'd be holding in my portfolio, as investors should really be de-risking from the retail side of the equation.
How are you looking at fundamentals versus growth, value stocks? How is your outlook kind of changing given the volatility and uncertainty overall in the macro environment?
Well, the macro environment tells us that there isn't too much upside to the stock market at this stage of the market cycle unless there is a positive China trade deal, even if that deal is cosmetic. If there is some miraculous way we can pull off a China trade deal, and even if it is, remotely cosmetic or barely cosmetic, any kind of a deal would lift the markets up another 5 or 10% from here. But where do we go from there as the economy keeps moderating is really going to be based on how quickly the economy moderates to the negative, and the fact that we are late stage bull market, and we're also coming to the longest term of economic expansion on record. We know what happens. Economics are cyclical. They just don't keep going up.
Right. I sort of was laughing inside when you said late cycle bull market, because I mean, we don't know. We could potentially go longer, right, Jeff? I mean, no one really knows, but yes, you're right. We're in like year 10 now, right? So it's a huge run up there. Does that mean, the higher that we've climbed, the longer we've climbed, that the come down is going to be really hard and really bad?
That's a great question, great points. It really does, because right now we're at $100 trillion of household net worth, the highest it's ever been. We're at about 540% as a ratio of household net worth to GDP. That is the highest it's been compared to the long-term average of about 324%. If we corrected back to the long-term asset price averages between stocks and real estate, we would see a 44% correction today from the present peaks in the market.
Last week, Fed Chair Jerome Powell had said the economy was in a, quote, favorable place, but he also implied they would act as appropriate to try to keep economic expansion on track. What are you looking for from the Fed, and how are investors kind of preparing for any future decisions on cutting interest rates?
I think expect the Fed to follow rates. When rates drop without the Fed lowering rates, they will continue to lower rates. But we are marching towards a 0% interest rate policy. And so they will ratchet rates down based on the economy's moderation to the down. Where the Fed made a huge mistake was raising rates 3 times last year and then promising in December of last year raising rates 3 more times this year. They seem to be behind the curve, and they need to find a way to get out in front of rates now that rates have inverted.
I've been asking some investors on the show here this question about whether or not you want to keep your exposure to China in your portfolios the same, or if you want to reduce them, given President Trump last week threatening or wanting companies here in the U.S. to decouple from China. Is that something that you would look to do if you previously were looking to China exposure for added growth in your portfolio?
I wouldn't be looking to China right now for added growth in their portfolio. I do not believe they've hit bottom. I believe there's going to be an anti-China methodology, not just economically, but politically going forward, as the hardliners in China will not allow the modernists there to come up with a China trade agreement and to create a free market system that's fair for all trading partners.
Yeah, to that point, you mentioned that there will continue to be uncertainty and unease amongst investors until even a cosmetic deal is reached between the U.S. and China. But what is the best case scenario for investors as to the actual contents of that deal? What would be the biggest win for U.S. investors specifically?
I think the biggest advantage would be there'd be a little more appreciation, and we wouldn't have the potential of all of this economic dislocation because both sides are paying a price. There is an unforeseen economic residual effect on many companies, not just companies that don't do trading with China, but also companies that are in between the mix. And so that is going to become more pronounced over time. And so we have what I would call a Mexican standoff at this point, where no one wants to capitulate, but something's got to be done because nothing has worked with China over the last 25 years.
All right, Jeff, thank you so much for being on with us. Have a great weekend. Jeff Small is president of Arbor Financial.